Okay, so let's get started. I know it probably sounded like I I wasn't here, but I was waiting for the 10 o'clock to roll around because I only have 40 minutes and theoretically it doesn't start until 10 o'clock. So what you're looking at on your screen right now are some of the questions that you'll see on your midterm examination. And although we generally think about that midterm as 5, 6, and 7, a lot of the questions are going to come from 3 and 4. And the reason for that is because they are heavily tested on your final examination. And you just went through a period where you did those. So they should be fairly fresh in your mind. And when we get down here a little bit further, excuse me, down around question 18 or so, then we get into 5 and 6. And then down here around question 35 or so, you're going to see a lot of ratio questions. And in this case, the acid test ratio, or sometimes that's called the quick ratio. And with the quick ratio, as opposed to the current ratios are current assets over current liabilities. The quick ratio takes out of the current assets prepaids and inventories, because what they're trying to do is they're trying to see how many assets, how many current assets you have that are almost immediately available for debt payment. And inventory is not that way. Inventory turns over a little bit slower in many, many cases. Sometimes inventory only turns over 3 times a year, or even less than that, meaning that you can get up to probably 120 to 180 days of inventory turn. And when you have that, then that doesn't make those funds that once you sell it, you have to sell it in order to get the funds back, right? So those kind of things are factored out of the acid test ratio, factored into the current ratio. And so you can see right here, I've got 35 through 40, those are all questions about ratios. And again, because I stressed ratios so heavily on my examinations, I wanted to give you yet another opportunity to go through those. Now, with respect to merchandise and merchandise inventory, let's talk a little bit about that. And well, I guess we should probably talk a little bit about some of these entries up here. Closing entries, as you remember, what we're trying to do is close the temporary accounts, which would be your withdrawals, your revenue accounts, and your expense accounts. We're going to close every single one of those ultimately to a capital. Now, in the case of revenues and expenses, we go through this account called the income summary. And that's all it does. It just picks up the revenue side, it takes the place of it, takes the place of the expenses, and we zero those out. Once we have done that, then the next entry is to actually get rid of the income summary. And it goes directly into the capital account or the equity account, if you prefer. And it itself gets closed out. Now, so if you're debiting the income summary to close it out, then that means that what you're also doing is you're crediting your equity. And the equity goes up on the credit or the right-hand side. So just keep that in mind. If you're crediting income summary to make it go to 0, then you're debiting the equity side, and that represents a loss. So what you can really do is you can look at the equity account and look at just the entry for the income summary, and that'll tell you right immediately whether or not you had revenue that exceeded expenses or expenses that exceeded revenue. Okay, now I wonder, there's probably some questions about the adjusted trial balance and so forth, because again, these adjustments are important. And because you cannot overstate your assets or understate your liabilities or understate your expenses or overstate your revenue. And the reason for that is that these things wind up at the bank. And when you take things down, financial statements down to the bank, then you're attesting to those financial statements. And from those financial statements, the bank is making loans. So if you deliberately, for instance, if you deliberately misstate your assets, in other words, if you overstate them, or you deliberately understate your liabilities or your expenses, or you overstate deliberately your revenue accounts, what happens there is the bank loans you money based upon that, and then you may default on that loan, and you then may be liable for any defaulted amount. So that is your company. So you want to make sure that you are taking care of that, and that's what really these adjusting entries do. They take your expenses and make sure they're all properly matched in the to the revenue and the period in which those revenues were earned. And so that's what you're looking for. You're looking to match those things up. In the case of liabilities, what you're doing, and those usually take the form in your adjusting entries of your wages payable. And so somebody has worked for you for some period of time at the end of the year, say 2 or 3 days. And so let's just make it easy. The 31st of December falls on a Wednesday, and you've had your employees working for you Monday, Tuesday, and Wednesday, but you don't pay those employees until Friday. Well, they've still earned that money, the money from Monday, Tuesday, and Wednesday. So what we have to do is set up an a wages payable and wages expense for the amount of money that they have earned in this year, okay, before the new year takes effect. Otherwise, you're not properly matching the revenues that you had in that year, the current year, with the expenses that you have in the current year. So you want to make sure that you match those two things up. That's one of the accounting principles that we follow. Okay. Take a look at some of these things as well. 2 common subgroups for liabilities on a classified balance sheet. And of course, what you're looking for there are the current and the longer term liabilities. And by the way, we should probably note that liabilities, even long-term liabilities, so let's say you have a mortgage, okay? And now we're at January 1st of 2020. And you have a mortgage that is a 25-year mortgage going forward. Well, what you have to do is you have to break that mortgage down into 2 components. The first one being the amount of money that's due in the current year on your mortgage, and the principal side of it, and the amount of money due in future periods. So everything from 2021 on. So you're breaking out the current and the long-term portions here. Okay, so that takes care of, I think, the discussion that I want to have about entries in terms of adjusting entries and closing entries. And so you'll continue to see these, and on your final examination, I hit those very, very hard. So, do your best to try to internalize what's going on with those entries. Okay, next we have merchandise that's sold. And up to this point, we've been talking about service businesses, and service businesses do not have merchandise inventory. A merchandiser, somebody like an Amazon or a Walmart. And what they do is they buy product from manufacturer, and they essentially just stock it. In other words, they don't usually do a lot of assembly or assembly of components and those sorts of things. Now, they will do some minor stuff like putting together a bicycle or something like that. And then even if you have it shipped to you, you're probably going to get it in pieces. Certainly that's the case for furniture and that sort of thing. So they're buying it, they're putting it on the shelf, and you're going into the company, or you're going into an online portal, and you're buying their merchandise. Well, what that then implies is that they have inventories. Okay. So when we think about inventory, we have a couple of three different issues that arise. The first is that if we are on a perpetual system, in other words, and that's what most companies, merchandising companies are on, is a perpetual system. In other words, they know what they're theoretically, they know what their inventory is all the time. And the way that they know that, and what you generally don't see, is how this works. So somebody comes in with a shipment and it comes to your warehouse, the back area of your, say, Walmart. And so somebody there at the receiving end or in the receiving department, they will scan each one of those pieces of merchandise as they come in, and that automatically puts them into the inventory of the company. And then when you go to the shelf and you pick up the can of beans, for instance, and you take it to the front and you scan that can of beans, what it tells you is that the price of the can of beans is $1.20. But in the background that you're not seeing, the can of beans gets taken out of the inventory at whatever its cost was. So if it was 80 cents, it comes out at that can of beans comes out at 80 cents. So that is how it actually works. And so on a perpetual basis, you should be able to know exactly how many cans of beans that you have at all times. Now, you don't. And the reason that you don't is because of things like theft, breakage, those kinds of things. Maybe some kid went through the aisle and knocked a can of beans down or something like that and put big dents in them, and sometimes they put them back on the shelf. Sometimes if it's a glass item, they can't. And of course, the managers, they get rated on that. Hang on one second here. I have to plug in because otherwise I'm going to lose you. My computer's supposed to have about, I don't know, 8 hours worth of battery life, and it does not have anything like that. Anyway, so now we know how the perpetual inventory is kept. The periodic inventory is different. A periodic inventory, we're going to only go out once in a while and take the inventory, maybe once a year. And when we take it, then we will adjust the cost of goods sold. That is the cost of all of those items at that point in time. Now, again, I don't want to get too far into the weeds here, but in the real world, it doesn't actually work that way. Constantly using either standard costing system or something like that to take it out of inventory, because we're reporting on it every month. Typically with a bigger company anyway, we report our results every month, and we compare those results for that month with the previous month. We compare them with that same month in the previous year and maybe the year before that. So we're looking for trends, okay? So anyway, now in addition to, anyway, let's follow this kind of through. So you start out and you have some inventory, and let's just stay with beans, okay? And call it green beans and the standard can size. So we have in the beginning inventory, maybe 100 cans of green beans at 80 cents a piece, okay? Or in this case, $80, okay? Now that's what's in our beginning inventory. So when we start to look at our perpetual system, we know that we have 80 cans at 80 cents, or I mean 100 cans at 80 cents. All right, so now we go out and we buy some more product. And if we don't have any returns of the product or a discount to the product or freight to the product, which we generally are going to have all of those things, but just trying to keep it simple here. If we don't have any of those things, then whatever we went out and bought would represent our net purchases of new merchandise. And so what we would do is we would add that net purchased amount to the beginning inventory, and I think you would agree that's the amount that's available for sale. What we started with plus what we purchased. Okay? Now, there are a number of different ways that we can get to the cost, but in a perpetual system, it's an automatic calculation. Every time something is scanned and goes through the line, then it relieves it from the inventory and it comes up with a cost number at the end of the month. And that's typically the way it happens. Okay. Now, we may have to do some adjustment for that based on shrinkage. Okay. Shrinkage meaning theft, breakage, those sorts of things. In the produce department, if you think about shrinkage, things, and not just produce, I guess a lot of areas where some stuff runs out of time. In other words, it's all based upon a certain amount of time that you can keep it. And once you reach that time, theoretically, they go out and they take it off the shelves. In the case of produce, sometimes it just goes bad, so they have to take it off the shelf. And those are the adjustments they're making to the cost of goods sold. And if you have shrinkage, if you have breakage and those sorts of things, then it's going to increase your cost of goods sold. Okay. Now, so if you think about this again, let's think about the normal progression here. We're going to start out with the beginning inventory, and we're going to add any purchases that we have, any net purchases that we have. That'll give us the goods available for sale. Now we're going to subtract the cost of goods sold, and that will give us the gross profit. And those are the differences when you have a merchandising business versus a service business. You have that addition of net purchases. And when we think about purchases, by the way, those are unique to accounting, meaning we're talking about merchandise here, something that they buy for resale. That's what a purchase is. Other things are not considered purchases. Okay, so now what we have is we have gross profit, a cost of goods sold, net purchases, and beginning inventory. And we're also going to have an ending inventory. And so if I want to think about how I get from one to the other, if I had a periodic inventory, what I would do is I'd go out and count the inventory. And then I would know how much I had in ending inventory and the difference between the net purchases plus the beginning inventory, goods available for sale, minus my ending inventory would give me again my cost of goods sold. And then the cost of goods sold from the net sales gives us then gross profit. And those are the differences that you'll see when you have a merchandising business versus a service business. Okay, so the rest of these are going to deal with, that is from here to, from 18 down to, I think it was around 35, are going to deal with various elements of your merchandise inventory, cost of goods sold, and those sorts of things. Now let's talk about when something becomes part of your inventory. So now we're at the end of the year, around the 31st of the year, and we bought some stuff yesterday, and it was shipped yesterday. Now, if it was shipped FOB destination, that is all the way to my door, then the merchandise is owned by the company that sold it to you. All right, and that in-transit merchandise would not be part of your inventory because your inventory responsibility picks up once it hits your door, and that's called FOB, free on board shipping destination. Now, if it ships FOB shipping point, that's a different situation. With FOB shipping point, the minute it leaves the shipper's dock, okay, the person who sold it to you, the minute it leaves their dock, it becomes your responsibility and therefore belongs in your inventory. Okay, so auditors come in, by the way, and they do what they call a cutoff. So they're going to look to see whether or not you've picked up things that belong in your inventory and have excluded the things that do not belong in your inventory. As inventory, other things equal, go straight to the bottom line. So ending inventory does. So that's one of the considerations that you'll see that we talk about in the next class. Anyway, so that gives you kind of an idea of how that works, and you want to pay very close attention to that section that talks about how net purchases are calculated, how net sales are calculated, and how this inventory and cost of goods sold gets accomplished. Okay, now we also have to think about the different kinds of inventories that we have, the inventory cost systems that we have. Now, or cost flows is a better way to describe it. So an inventory cost flow is either going to be, for your purposes here, it's either going to be specific identification. Specific identification, that would be like an automobile, because every automobile has a VIN number. So we know exactly what automobile was sold, and we can specifically identify it. So as long as we know that, we just go back and pick up the costs associated with that particular item that was sold. And also, of course, when it came in the door, we would account for the cost to us, and then we would account for that cost to us as it goes out the door, specifically, okay? Now, another way to look at it, the cost flow, is a first in, first out method, and that's what about 85% or so of all businesses use. The first in, first out method means that the first ones in are the first ones out. So the last ones that you purchased are what wind up in ending inventory. And, you know, typically, if you think about it, I mean, most companies do first in, first out because it makes sense. They want to sell their oldest merchandise first before they sell their newest merchandise. And that's particularly true with anything that may wind up with potential spoilage, so grocery stores in particular. It's also true with computer companies. You know, computer companies, if they sell a computer, they want to sell the oldest version of the operating system first because it's slower typically. And so they want to sell those first before they sell the new ones. And of course, the pricing also reflects that. Another way to look at cost flow is last in, first out. So it's exactly what it says. The last ones that you bought were the first ones that go out. Last in, first out is kind of a unique way of looking at things. It's you can write a book just based on last in, first out inventories because you have lots of considerations that you have to consider. Layering and all, LIFO layering and all sorts of other things, which you will not get into. But right now, just know that the last ones that you bought were the first ones that go out. So if you sell something, you don't look at the things that were in your beginning inventory first. You look at the things that you just bought first. That's the opposite of first in, first out. With first in, first out, you're going to look at your beginning inventory and eliminate all of those, and then your first purchase and eliminate all of those, and then your second purchase and eliminate all of those. In the case of last in, first out, you're going to look at your last purchase and eliminate those. And if you have sold more than just that, what was present in your last purchase, you'll go to your next to the last purchase, and you'll take the cost out of those, and then you're next to the last purchase. Okay. And then the last one that you need to think about is the weighted average method. And the weighted average is the same way that, by the way, you calculate your GPA. So if your GPA, let's just take a practical example. With your GPA, let's say that you have a 2-hour class and you got an A in that 2-hour class. All right, so an A is worth four points, and so that's 8 points. And now you have a 3-hour class and you have a B in that 3-hour class. So you have 3 points associated with a B. So that's 9 points. And so 9 plus 8 divided now by 5 will give you your GPA. So you can't just take the A at 4 points and the B at 3 points and add them together and divide by 2. you won't get your GPA like that because you have different, there's a different worth to a 2-hour class than there is to a 3-hour class. And so, I mean, that's the way that you would handle GPA. And the same thing happens with a weighted average inventory. So if you buy 100 items in at $10, okay, so now you have $1,000, and then you buy another 100 items in, excuse me, if you buy 200 items in at $11, okay, you would multiply that 200 times 11 and get 1,100 times 2 or 2,200 plus the $1,000 that you had and divide all of that by 300, and that will give you your weighted average. Now, on every accounting examination, if they give you the question, if they give you a question about where each one of these falls, the one with the highest cost of goods sold is always going to be LIFO, because we, in accounting, we always assume that prices are rising. So if the last ones are out first, then that means that the highest costs go out first, and your cost of goods sold is based on your cost. So if it's LIFO, then LIFO is going to represent the highest cost of goods sold and the lowest gross profit. Now, with FIFO, it's just the opposite. It'll represent your lowest, because it's the first ones that came in, your lowest cost of goods sold and your highest profit. So the weighted average method always falls in between those two. Every single time it falls in between those two, because it's more of a weighting. Okay. Now, here's something that you should probably know. You can go from LIFO to any other method that you want without notifying the IRS and going through or getting permission from the IRS or anything like that. It's not a problem. But you can't go from any method to LIFO without getting IRS permission. Now, I want you to do a little bit of critical thinking here. If under LIFO, it has the highest cost of goods sold and therefore the lowest gross profit, why do you think the IRS is not going to allow you to do that without permission, change from any method to LIFO? Well, the reason is because if you have the lowest gross profit, you're also going to have the lowest net profit. And net profit is what income taxes are based on. So it means that the IRS will collect fewer taxes if you go from FIFO to LIFO. All right. So they make you ask permission. You have to have justification for doing it. When you start your business, you can start with LIFO without a problem. But if you're trying to transition from FIFO to LIFO, then you have a problem. Okay, so first in, first out. What does it mean? It means you have the first ones that come in and the first ones that go out. That means that from a cost perspective, your cost of goods sold is going to be, in a period of rising prices, it's going to be lower than FIFO. That means your gross profit is going to be higher than FIFO. Higher than LIFO. With FIFO, your gross profit is going to be higher than with LIFO. All right. And so obviously the other side of that is true if you're on the LIFO system. And again, this assumes a period of rising prices. And so I think we can safely assume that that's going to be what's going on for some period of time now. Okay. I think that's pretty much what I want to talk about for this one. So, make sure you study very hard on the closing entries and the adjusting entries. Make sure you study these inventories that we're talking about, or I've just gone through, and know how to put that together. In other words, know that you're going to start with net sales. So that's gross sales minus returns, minus returns and allowances, minus discounts. That gives you net sales. And then when you have your beginning inventory, plus your net purchases. Net purchases are gross purchases minus any purchase returns and allowances, minus any discounts, plus any freight that you have to pay. That will give you your net purchases. And your beginning inventory plus your net purchases minus your cost of goods sold gives you your gross profit. Okay, well, I hope that's pretty clear, but don't just rely on this to tell you that. You need to go back and make sure you have internalized it, because that's the kind of thing you're going to see on this examination. The examination, by the way, will be open to you from 12 a.m. on Thursday morning until 11:30 p.m. on Sunday evening. So you have quite a large period of time in which to take the exam. And the reason that I like to do that is because I don't know how many of you may be working during this period of time, or maybe traveling or whatever. So this gives you at least a 4-day time frame in which to take these examinations and so forth. And with that, I think we are essentially done. So if you have any questions, feel free to send those to me, and I'll be glad to answer them for you, or you can give me a call at 478-279-4139. I'll be glad to answer any questions that you have, any concerns that you have going forward. So thank you for your time, and I will see you the next time around.